Research has shown that planning for retirement is one of the greatest anxieties people face in their life. If that were not enough, did you also know that the retirement system itself is actually rigged against you? Hi, my name is Greg Parker with Engrave Wealth Partners. Thanks for tuning in and watching our Retirement Basics video series. Today, I want to present an overview of why retirement planning is so challenging and a few things that are hidden in the retirement planning process that you may not know about that could really come back to haunt you. Thinking about retirement, there are really three big decisions that we usually talk about when it comes to retirement. The problem is most people stop after two. Thinking about where your retirement income is going to come from sounds fairly basic. Trying to build that income in a way that a portfolio can provide for is fairly simple as well. Looking at investment options, measuring risk, those are things that are very common in the field of retirement planning today. What most people overlook is the impact of taxes when it comes to their retirement. And when you think about the impact of taxes, folks, that's an important third leg of the stool that could actually be very detrimental to your long-term planning. Why is that? Well, unfortunately, taxes are going to account for your single largest expense in retirement. When most people put together their spending budget for their retirement years, we seldom see a line item for taxes paid. Unfortunately, most retired individuals are going to recognize a rising stream of taxable ordinary income starting at age 72, even if you don't need the income. Now, that may come as a surprise to you. You may say, well, that can't happen to me, Greg. I'm going to already be retired. I have no other jobs, no other income that's going to be coming in. Why would I see a rising stream of taxable ordinary income? And what in the world is that anyways? Folks, taxable ordinary income is what the IRS refers to when they're talking about things like salary and wages. What in the world is going to generate additional salary and wages for you starting at age 72 and go higher every year thereafter? Well, I'm glad you asked. When we think about the tax problem in retirement, most people overlook one very simple planning principle. That is that every one of us faces a point where we recognize that we've benefited from the retirement planning allowed to us in a 401k. Folks, a 401k, simply put, allowed you to save money on a pre-tax, tax-deferred basis. That means that any income that you took from your paycheck to put into a 401k, you didn't have to pay taxes on at the time. And any investments you made, whether you earn dividends or interest or capital gains, you didn't have to pay taxes on. Why? Because the idea is that when you're withdrawing income from your 401k or IRA, that income would then be taxable to you at that time. The whole premise of retirement planning is you can defer those taxes in your higher earnings years until your later retirement years, when ideally your tax bracket should be a lot lower. Unfortunately, we're not finding that to be the case very often. But I know some of you are looking at this saying, okay, if that's the case, I'll just live off of Social Security or other savings. I won't touch my 401k or my IRA. I'm going to let it just sit there and I'll pass that money on. Well, unfortunately, the IRS disagrees with you. The IRS has a rule. It's called RMDs, or required minimum distributions. Folks, required minimum distributions start at age 72. And the way the rule works is if you have not begun withdrawing from a 401k or an IRA by age 72, the IRS says you must now begin withdrawing those funds from your retirement savings, recognizing them as taxable ordinary income. You don't have a choice in the matter. In fact, if you choose to ignore the rule, the penalty, according to the IRS, is 50% of what you should have withdrawn now gets paid in as a penalty. Folks, that's a stiff one you don't want to deal with. You need to understand the benefits of planning early, thinking about what those RMDs are going to do for you at age 72, and understanding the impact that tax is going to have on you. What is a required minimum distribution? RMDs basically say that you may not leave funds invested in retirement accounts indefinitely. That is a broad definition for retirement accounts that includes not only the 401k, it includes an IRA. If you're self-employed, it includes things like self-employed plans, simple IRAs, self 401ks, Even the 403Bs that you might have had working for a nonprofit institution are applied to the required minimum distribution rules. Figuring out those rules is very simple because the IRS tells you how to calculate it. The calculation simply says at age 72, we're going to look at the value of your account at the end of that year. You're going to divide that account by a given IRS factor to determine the amount of money that must be withdrawn. What does that factor look like? Well, it's a set number based on life expectancies. Currently, at age 72, you would divide the entire balance of your portfolio by 27.4. Now, that's a fairly simple calculation, but here's the kick you need to know. Every year after that, that factor is going to go down in value, meaning that when you apply the RMD at age 73 or 74 or 75, the factor is going to mean that your distribution is very likely going to be bigger than it was the year before. That's why I say most of you are going to recognize a rising stream of taxable ordinary income beginning at age 72 that could go on until the account is depleted or until you're gone. What does that look like for most people? Let's assume a hypothetical retirement at age 60 with simply $1 million in an IRA. That hopefully makes the math easy to calculate. Assuming a 5% compounded annual growth at age 72, that IRA balance is nearly $1.8 million. How do I calculate the RMD? Again, that balance divided by 27.4 means I'm going to recognize taxable income in my 72nd year of $65,542. Folks, that's going to get reported to the IRS at the end of the year. That's the amount you must pull out of your IRA. You don't have to spend it, of course. It simply needs to go in to another investment or brokerage account or bank account, but it is going to be reported to the IRS as taxable income, and you will owe taxes next year on that amount, plus other income you may have. What other income might you have at age 72? Pretty sure most of you are going to have Social Security income at age 72. 85% of your Social Security benefits will be added to that taxable income. Can you see where the tax problem is going to come from? Folks, thinking about what that's going to cost you, again, hypothetical 5% annual growth for various amounts at age 60, growing until age 72, your IRA could be worth as much as $9 million at that age. Your first year RMD could range anywhere between that $65,542 all the way up over $300,000. Folks, if you have no other income to report, which I know is not the case because of Social Security, but if this is the only income you've got, based on the 2021 marginal tax brackets, married filing joint, this would be the applicable tax bracket you'd be falling into, and you'd be looking at tax bills of anywhere between $7,500 and $66,000 just in that first year. If you've not accounted for that expense in your retirement budgeting, you've got a big wake-up call coming. That needs to be considered as your primary expense before all others. How we look at this problem is very significant, and understanding the cost of being wrong and even the cost of compliance means that you need to think about doing some advanced planning. These tax rates are only going to change in the future, folks, and what we're looking at right now is the best way to solve that problem is to be thinking about retirement from a big picture of how to get the most tax efficient, tax mindful distribution and cash flow strategy that takes into account what those distributions are going to look like. I know most financial advisors are going to tell you we don't provide tax advice. You need to go talk to a CPA. That's not what we do here. In fact, when we think about your retirement investments, whether they be in an IRA, an after-tax brokerage account, or a Roth IRA, we're going to work with our in-house CPAs to help you know exactly where those distributions need to come from and how they're going to be taxed. Frankly, any income that you take from an IRA is going to be taxed as ordinary income, whether that's at age 72 or before. However, income that we take from an after-tax brokerage account could be considered tax preferred. Now, what does that mean? Well, it simply means the taxes due on any distribution from your after-tax account will depend upon how the money was invested, whether you use tax-free municipal bonds, qualified dividends, or long-term capital gains. Those are all beneficial compared to ordinary income. Finally, if you've been wise in setting up a Roth IRA and you meet the qualifications for that Roth IRA, you might be eligible to receive tax-free income from the Roth IRA as well. The problem with this scenario, as you can see by my buckets, most people don't have a big enough Roth to live off of in retirement. The IRA happens to be generally the biggest source of retirement savings when we talk to retired individuals, because it's the place where the 401k or any pension benefits probably are deposited. Folks, thinking about this balance and understanding the tax implications is extremely important when it comes to your retirement. We need to answer those big questions of, can I even afford to retire with what I've got? Or how much income can I get based on what I've saved? And what is the tax implication of all of those? Folks, we answer those questions for you in our free, no obligation retirement optimization analysis. This is an analysis that we can build for you within 24 to 48 hours of receiving your information. In order to build the analysis, we simply ask for some basic information. Things like, if you have a pension, what is that pension going to be worth at retirement? What kind of 401k savings plan have you used and what are the benefits there? Other retirement investments or other investment accounts, including your Social Security. We'll put them together in a comprehensive plan, provide that for you with no cost, meet with you via Zoom or in our office to help you know exactly what your choices are. Folks, don't delay. If you can, go to the website, engravewealth.com, click the Start Your Free Plan button. We'll collect that information in a secure, confidential way and get that analysis built for you within 24 to 48 hours. We would love to sit down and talk about these questions with you, because what we've seen consistently, nobody thinking about retirement plans to fail. They simply fail to plan. Thanks for watching the video, folks. Be sure to tune into our next video talking in detail about the tax problem in retirement and some simple steps you can take now to minimize those taxes later on. Have a great week. We look forward to talking to you.